Okay, well, welcome everyone. My name's Eddie, as you can probably see on the screen. I'm the lead content creator here at Finimize. Welcome to this session. Super excited to be moderating it. I'm here with a very special guest, Felicia Hjertman, who is the founder and CEO of the DIY investment platform TILLIT, which during my research, I found out that it's actually means trust in Swedish. She was at Bailey Gifford as a fund manager for 8 years, managing Japanese equities. I think she managed an £18 billion portfolio. TILLIT really filters the market to deliver a curated universe of what they believe to be the best-in-class funds, investment trusts, and ETFs, making it easy to invest in what matters to you. So today's workshop is going to be how to pick funds versus stocks. Just before we start, before I pass on to Felicia, we'll do some housekeeping. If you haven't already, please introduce yourself in the chat box with your name and where you're tuning in from, and answer the poll, which is just about to pop up now. This will be a 30-minute workshop followed by 15 minutes of audience Q&A. Don't forget to ask your questions in the Q&A box and upvote your favorite questions. Just as a reminder, you could actually win £1,000 with TILLIT in their competition, which ends tomorrow. They're going to be giving away £1,000 straight into a TILLIT account, and all you need to do is open up an account with £100 today. So one lucky winner could get this. So really nice prize there. So let's dive in. Take it away, Felicia.
Brilliant. Hi. Thank you for that intro, Eddie. Very excited to be here. I'm going to share my screen and bring up that presentation. Brilliant. Oh, sorry. No, hold on. Let me try that again. Technical difficulties to get us started. Now, does that work? Can I see anyone? Does that work? You can see me?
All good.
Brilliant, brilliant. So thank you so much for that wonderful intro, Eddie. I am indeed Felicia. I am the CEO and founder of TILLIT. I should just mention that in terms of how much money I was managing, that was the whole team. So my fund was much smaller. That was co-managing. I should mention that because otherwise the team might be like, oh, really? But anyway, so this workshop today, I'm very excited. I am passionate about investing and funds and so on as well. So I'm going to focus on how to pick funds versus stocks. I'm going to try to talk a bit about the purpose and the pointers and the pitfalls. And I look forward to the Q&A at the end of the talk. So first off, Eddie very kindly gave me a very wonderful intro there, but I wanted to go in a bit more about why you should care about perhaps anything that I have to say. And that really is because I, as we mentioned, am the founder of TILLIT, and we're trying to build a platform that helps empowers people like us on this call to make better investment decisions and invest in funds in an informed way based on fundamentals. Now, before I was doing that, 3 years ago, I left Bailey Gifford, where I was an investment analyst and fund manager. And so I was essentially a stock picker for a living. And so when it comes to picking investments, that is something I spent a lot of time on doing. And I wanted to share some of the insights and the lessons and learnings that I've learned across the way. I've spent time in my experience with Bailey Gifford across European equities, corporate bonds, and finalizing on the Japanese equity market, particularly in the small cap space. I'll give a couple of anecdotes about that later. And manage money for institutional and retail clients. And we'll talk about different fund structures as well, including some of the ones that I was managing. To get us started, I wanted to start on stocks because, first of all, we all know that stocks are sexy. And most of the people on the call will probably be particularly familiar with picking stocks. And so the rest of the session will be more focused on funds. But I just want to go through a few different things on the stock picking side first. Now, the first thing I want to do is go through what we as professional investors, professional stock pickers do when we're building an investment case, because essentially you as personal investors will be building your own investment cases, right? And I wanted to go through all of the stuff that goes into that. So the first components really of, we would spend anything between 2 and 4 weeks of putting together an investment case. Now, that involved a number of things, such as we went back 10 years in the company's history over their annual reports, and we poured through everything, qualitative, quantitative, going through the accounts, everything. We built models on the back of those accounts. We made adjustments to those financials. We spoke to competitors. We looked at SWOT analysis around like what are the internal opportunities and drivers, the external threats and challenges, so on. We spoke to experts. We poured over earnings calls. We spoke to management many, many times over. And we also built various different valuation models, site visits, etc., etc., etc. And once we've done all of that, we then would have the opportunity to speak to colleagues, people who might have been looking at a competitor in a different market, in a different kind of area of a competing industry, whatever it might be. We then moved on to a stock discussion where my colleagues would very helpfully kick the tires on the investment case, to put it lightly, to really try and figure out, is this a worthwhile investment? And once all of that work is done, the main thing really then is to try to figure out, well, what's our point of view that is different to the market? And I think this is a really important one, because you can do all that research and find that, okay, I know a lot about this company now, but ultimately trying to invest in equities is trying to make a return by believing something that others can't see right now. There's a value that the market has put on the stock, and you're trying to figure out why it should be higher than that in the future, right? And I think what you also need to figure out is, what are those catalysts of, if you do have a differentiated point in the market, why is that? Why is no one else seeing what you're seeing? And I think you have to be honest with yourself and ask, are you that clever? Like, as an ex-fund manager, I don't think I am anymore, because I'm not in it. It's a bit like languages. You don't keep that up in the same way. That is my point of view around picking stocks. And I think you also need to figure out, what are those catalysts that will help that investment case fall true? Otherwise, there's no point. If you have a differentiated point of view that no one else comes to, then that investment case is unlikely to play out. And so all of this takes a lot of time. The research phase takes a lot of time. The making a decision takes a lot of time. And then once you've made that decision, you need to monitor it and follow it and make sure that you're on top of any changes to that investment case. What does that mean for your investment case that you've made? And so on. And so if we were in a real room, and in fact, that's probably my first question then to everyone on the call, is that, bearing all of what I said in mind, that we would spend 2 to 4 weeks full time on one single company, how many of you would spend 2 weeks full time analyzing a stock? And so maybe there's something that we can go into the Q&A, but I think it's really important to bear that in mind, because essentially that's your competition. And that's the minimum that the industry spends. And so that brings me on to a little bit of a confession. So you might think that as an ex-fund manager, and I used to pick stocks for a living, my portfolios are probably full of stocks, right? They're not. Since I left as a fund manager to build TILLIT, I don't invest in individual stocks anymore. And the reason for that, I still very much invest, but it's because I don't think I have that time, that expertise, that access that I think you need to be able to make decisions based on fundamentals. And there might be different views on that, and I'm sure we'll come on to that in the conversation afterwards. But so what do I invest in instead? I invest in funds. And that's what we're going to talk about for the majority here. And before I go into the different breeds and styles and range and so on, I wanted to go in a bit broadly around why funds, taking a step back. I think stocks get all the limelight, and funds is something that not a lot of people necessarily know much about and understand the breadth and range that there is in the industry and what funds can really do for you in a portfolio. I think particularly now in the market that we're in, stocks can be quite tricky. It's a very volatile market, and therefore funds, I think, should be seriously considered to be part of anyone's portfolio, regardless of what your goals are, what your risk level are, and what you're looking for. And for me, that comes down to the fact that you have an enormous range with funds that gives you access to areas that you don't otherwise as a personal investor actually would have. I mean, stocks in itself is equities only, right? Funds can give you access across a multitude of asset classes: bonds, alternatives, infrastructure, commodities, private assets. I can go on forever, right? And that's really exciting. And then on top of that, you can have the expertise if you pick a manager, and we'll talk about how to pick managers and so on as well, if you want to invest in an actively managed fund. And then fundamentally gives you diversification. Instead of picking one company, you're picking a number of funds that in themselves have a collection of assets inside them. And so you end up with a more diversified portfolio from the get-go, and you also end up with a risk management side of things, which is quite tricky to perhaps manage yourself. So that's some of the reasons why I find funds particularly exciting. And so what we're going to go into now, first off, is breeds, styles, and range. And really, again, I could talk about these things for days, and I know we only have half an hour, so I'm going to try to be quick. Happy to go into it in more detail in the Q&A afterwards, or indeed pop it over an email. Happy to talk about this forever. But there's a few different ways that you can cut and slice the fund market. One good place to start, I think, can be on the passive versus active. There's been a big discussion in the industry for a long time now around, is active even worthwhile considering? Passive is the new range, and all of that. And that might be the case. It's not saying that one is better or worse than the other. And I think what you have to consider is that the whole point of passive is to track a market, an index, a certain type of asset class, and to do that as cheaply as possible. So essentially what you end up with that is you get the market return minus, as I say, because there's still a fee. So you can't really get more than the market, you get that market minus. Whereas with active, if done well and properly, you could get, you may not do, but you could get this potential to get market plus after fees. And that's the whole point of why active exists, is to be able to outperform the market and do better than the market in that sense. So there's a few different styles of funds. There's actually quite a lot, but I'm just going to dig into a few main ones because it will help set the scene. So the first one is open-ended funds. The second one, investment trust, and the third one, ETFs. And I'll talk a little bit about the differences at a high level on those. And so with open-ended funds at a high level, you're essentially buying units in something. It doesn't trade on an exchange. And instead you go to the asset manager and say, hi, I want to buy 500 quid in this fund, and they create the units, and you essentially own a small fraction of the underlying assets in that fund. Now, they can be either actively managed, which means the fund manager is making the decisions, or passively managed where they track an index or a market, as we just discussed. Quite straightforward. When it comes to investment trusts, that's something more niche. It's not as well known, but it can be a really interesting type of fund to consider. So with investment trusts, they are always actively managed, and they are listed on an exchange. So essentially, it is like a company. It's a fund, but it's decided to list itself as a company on an exchange. Some of them are as big as listed in the FTSE 100. And the difference with that is that it has a board, because it is a company. And that board has a fiduciary duty to you as investors in that trust. And what that means is that you also get a board who can decide that if they think that the fund manager is underperforming, they can move that trust over to a different asset manager. So the opportunity with investment trusts, one of the opportunities with investment trusts, is that something that might have been underperforming for quite some time, if that board decides to change managers, that can change the philosophy, the process, the people, the fee, everything can change for that trust in a way that you don't typically see with open-ended funds. And I should have mentioned earlier, with open-ended funds, if you're looking for what is an open-ended fund on the platform, typically they're designed, the most common structure is an OEIC, which is an OEIC, which is an open-ended investment company. Investment trust is an investment trust, usually a closed-ended company. And so I think the apart from moving from one asset manager to the other thing that's really important with investment trusts is that they can take on debt to amplify returns, or indeed can also amplify losses. So there is potentially an additional risk with investment trust, and they tend to express this by calling it gearing. Now, gearing is usually expressed as a percentage, and it's something that I'm raising it because it's really important if you're considering investment trust to be aware of, is it taking on any gearing, and how high is that? Anything between 0 and 20-25%, 20-25% being pretty high. And I'm not going to dwell on what gearing really is, but a good way to think about it is just like if you're analyzing a company and that has debt on the balance sheet, it's the same thing with the trust. So that comes with additional risk. And so that brings me on to the other thing, is that if you see a performance chart for an investment trust, you'll typically see two lines. You'll see a net asset value line, which is essentially the value of the assets in that trust and taking into account any debt as well. And then you see the share price, because as I mentioned, investment trust is listed on an exchange. What that means is that you're buying the shares in that trust, and the value of that is what you pay for the shares. Now, that might be different to the value of the underlying assets. So a trust might invest in a range of different asset classes, but let's say for the sake of the example, invest in listed equities. That means that the value of those listed equities will move daily. But sometimes for different reasons, maybe the investment trust isn't very well known, or it's not catching up with it as quickly, you might have a discrepancy. And so if you end up in a situation where the share price of the investment trust is higher than the value of those assets, the net assets, you end up with the trust trading at a premium. And so you're essentially paying more than the value of those assets according to the market. And the inverse is true of if it's trading below the net asset value, in which case it's trading at a discount, which is essentially like buying it on sale. Now, that doesn't mean in itself that that's a reason to buy an investment trust or sell an investment trust. But what is important to note is that there's a few different reasons for why that might be. For instance, if you might trade at a premium if there's a particularly well-known manager who's got a great track record, or they might invest in an area of the world or the market where you can't get access as an individual. So you're kind of paying a premium, essentially, sense of the word, for that access. The inverse in terms of a discount might be that those assets might be unlisted. They might be more illiquid. It might be harder to determine the value of those, or indeed, as I mentioned earlier, a bit of a lag in the market. So with investment trusts, they are like open-ended funds, but listed with all of these other different kind of complexities, which can be really interesting and unique for a personal investor to consider in their portfolio. Which then brings me on to the last one, ETFs, which I'm not going to dwell on because I know that most people are very familiar with what ETFs are. Exchange traded funds, essentially a passive fund listed on an exchange, where again, you buy shares in that ETF. Most of them are passive, not all of them. I know that we've got a wonderful Kathy Wood tomorrow from ARK. That's a much more actively managed ETF, but most of the ETFs are tracking a market or a set of assets in one way or another. And they trade on an exchange, as I mentioned. There's also exchange traded commodities, which would track a particular commodity as well. But so that kind of just sets the scene of some of the range that you have in funds. But what's also important is this to re-emphasize that there is really that range of asset class breadth, infrastructure, bonds, equities, commodities, private assets, any kind of alternative assets in that way. You also have regions in a way that with stocks. So for instance, if you wanted to invest in Vietnam or in China or in very small economies in Africa or Latin America, that can be really hard to get access to as a stock picker when you're trying to find individual equities. We have great coverage of the US and the UK and some of Europe here in the UK, but it's much harder and sometimes impossible to get access to those other regions in the world, which is something that a fund can do for you instead. The other thing to bear in mind is anything from micro caps to mega caps. So a micro cap is a really, really tiny company, and which again might be really hard to get hold of, especially if that tiny company is in somewhere like India, up to the mega caps, the big known names that we all know. So there's again a huge amount of range of the type of exposure that you can get if you invest through funds. And then there's of course the sectors and themes and the added expertise that you may, if you're backing a fund manager who might have particular expertise in a sector. So setting that scene, it's really about funds, no matter of how niche you want to be or go in terms of your exposure in your portfolio and why, up to buying the broad market. It's and everything in between, which is why I think it is such a great vehicle for anyone to consider. If you still want to be in control and you want to pick things that are aligned with what you believe in and the worldview that you have and where you want to place your money, you don't have to just pick stocks. You can actually pick quite specific funds as well to do that. And so I think that's the final point I want to mention on that, which is access. And we're going to come on to that as well. Because of those different areas that a fund manager, professional investor can go, it's almost like a fund or a fund manager can be like your backstage pass at a concert. So that's one good way, I think, to think about it. So then moving on to horses for courses, which is trying to go into a bit more like, well, when should I pick one versus the other? It's not that one of these are better than another type of fund. It's more that it depends on what you're trying to achieve. So I obviously can't give personal financial advice, but I do think that there's some broad themes which are good to consider for different vehicles. And so the first one of that is asset classes. I gave a few examples earlier on investment trusts, but where investment trust and closed funded structures where it's a listed company, permanent capital essentially, is anything that is a bit more liquid. So when I said illiquid, so like property, alternative assets. Many of you might have seen what's happened in the last year, 18 months around open-ended property funds. Because if you're in an open-ended vehicle, you can, as an investor, want to pull your money in and out very quickly, but the underlying assets might be a lot more illiquid. And so the fund manager can't quite keep up, and it becomes a very difficult thing to manage that. Whereas when it's in a closed-ended fund, you don't have that same problem. So that's one area where it might be interesting to consider. Is there a closed-ended vehicle if you want to have exposure to those kind of assets? Private assets is another area for that. Another one is regions and styles. And I think this is where it's interesting of passive versus active. I genuinely think there's a place in every portfolio for both. But there are some areas. So for instance, one way to think of where passive might be useful is in very large, efficient, transparent markets. Like take the US in terms of regions, the US and other very large, transparent, developed markets can be harder for an active manager to outperform. And you might just want to track the market because there's so many eyes on that market. There's so much good quality information, regulation, transparency, disclosures, all of that. It is trickier. It can be trickier. Doesn't mean it can't be done. There are some people who are exceptionally good as active managers to go into the US, but in general, it might be a bit trickier. And related to that is when we talked about mega caps earlier, if you're looking to invest in some of the best well-known names, then again, there's a lot of people who follow that. The sell-side analysts and the general market tends to write loads about the most biggest companies in the world. And so it's much harder, again, to have a different point of view. As I mentioned, you have to have, where do you differ from the market? If everyone knows everything about it, it's much harder to do that. So the inverse of that is then where might it be interesting to consider active is the flip side. So emerging markets where perhaps information is not as easily available. There might be language barriers, there might be disclosure requirements that are different, there might be accounting practices that are different, there might be just a general transparency in language and so on that might be harder. And so that's where, if active is done right, can potentially be quite interesting. It's almost, again, like you have a guide in those markets, knowing what to avoid and what perhaps is more worthwhile investing in. Equally on the smaller cap end of the spectrum, if you're investing in things like really, really tiny companies, anything from micro cap, small cap to mid caps, they're a lot less covered. People don't care. The investment bank's like, I don't care. And so you end up in a situation where, not because it's not a good investment, but it's such a big market that no one else might be looking at it. So like I have an anecdote because I used to manage Japanese small cap equities, so small companies in Japan. And this happened many times over, but one time when on one of those investment trips, I took a 4.5-hour one-way train journey from Tokyo to go and see this one company. And I got there and it was a tiny company and they were just like, how, obviously they knew I was coming, but they were astonished at how we'd even found them and that we made the way there. And we got therefore an amazing access to speak to so many of the people to really understand what the company does. And that's the kind of things where if you go a bit where others don't want to go or don't want to make the effort to go, that's where active can really add a lot of value as well. These are just broad generalizations, but good to bear in mind. And I think the last one I want to mention there is market conditions, which is why I think now is such a timely point to do a presentation about funds or a workshop about funds, because typically in volatile markets, that should create, for good active managers, a better time to outperform. Because when markets generally are moving quite steadily in one direction and everything's rising, then if you're in the index, everything's going up. Happy days, honky-dory, everyone's brilliant, right? Everyone owns everything. If things start to go down and things start to move around a lot more, even more so, then you still own everything if you're in an index. Everyone's going to the exit at the same time in the same assets, whereas what an active manager can do, depending on their remit, is to decide to, I'm going to completely ignore that part of the market, that sector, those companies, whatever it is. And you can kind of whiz around in a completely different way compared to if you're buying passive, where you own both the baby and the bathwater, essentially. And so those are some of the things to consider there, I think. And also, as we mentioned with investment trust, in volatile markets and price swings move quite a lot, there may be opportunities, again, for buying things at discounts, investment trust at discounts in a way that you perhaps in a more stable market would struggle to do, even if the investment trust is still a great investment, same people, same philosophy. Because of everything going on in the market, there might be an entry point that is particularly interesting for the investor. But that then brings me on to how do you then pick the funds that you want to invest in? And the whole point of picking anything when it comes to investing, whether it's a stock or a fund, is to look to the future. It's not to look to the past. And we all know past performance is not a guide to future performance and all of that stuff. But then why do we spend so much time on it? Why do we spend so much time on looking at backward-looking information? And I think it's really down to a simple thing of there's not much else to get hold of as a personal investor, and especially on the big platforms. And this is where companies like Finimize can really help with content, but I think it goes beyond broader market content about the funds. Because as a fund manager before, where performance was kind of what got us in the door or on the sheet, and with the rest of the process, 95% of that process was really to try and to grill us as fund managers. And that's a really important part to remember, because that's what you have to do as a personal investor. You have to go through that investment case and you have to try and figure out, what is that fund trying to achieve? What is the process? What is the philosophy? What is the people who are managing that fund? Just like you have a belief around what's the world going to look like and what do you think is going to happen in the future, so does the fund. So do the people who are making those decisions. And it's trying to find the right ones of going into that and analyzing that, which is what we at TILLIT and the experts at TILLIT do a lot, to try and then give that information back to you as a personal investor to make that decision. And so if you don't have access to that as an individual, then it can be helpful to go to places like the company's websites and the asset manager's website. Of course, there's sales speech and so on. There's also fact sheets, which really range in quality and so on. But it's really trying to figure out, what is this fund trying to achieve? And therefore, is that aligned with your goals? And what is also really important is trying to assess what is skill versus luck, which is one of the trickiest parts. And I think if you're picking an active fund, a lot of the skill is really down to, what is that process? What is that philosophy? What is the consistency around that? Versus luck is perhaps a bit more when it comes into timing of the market and so on. And it's really important that you buy into managers who believe in their style. I think one thing that's happened over the last 10 years really is that you've had a lot of growth style managers has been all the rage, and value style funds, for example, have just gone away. They've lost their job. They don't want to admit that they're a value manager, and they just don't do it anymore. And I think that's really important, that not everyone can outperform in every market. And it's about trying to, as a personal investor, figure out what do you need in your portfolio and how do you make that work as a holistic thing. I know that we're running out of time a little bit, but I do want to just mention these things as well, because it is really important very quickly, is that as pitfalls, if you're picking stock, one of the most common ones is that just because you like a company's product does not make it a good investment. And I think this is something we talked about before. There's so much more complexity in there, and you have to bear that in mind. Equally, hot tips, just because your friend likes it doesn't make that it's a good fund either, and their circumstances might be very different. And equally, the fund names, I think it's like ordering wine in a restaurant. A lot of fund names don't make any sense. And I think just because there is one that sounds cool doesn't mean that it's a good fund. You wouldn't buy a house on a street that sounds cool without going into the house, probably. And it's a bit similar here. And so I think that's another one that's really important. And the other one is unintended concentration. If you own a US fund, a tech fund, a global fund, and a sustainable fund, you might think that you are diversified. What you will find, if you actually look into that, look under the hood, is that there's a lot of overlap in the underlying holdings of those funds, and that is because the global market and global indices are heavily skewed towards the US. The US in turn is heavily skewed towards tech. And then you've got sustainability, which also historically at least has been heavily skewed towards tech and healthcare. And so it's really important that you understand what is in those funds. And I would really bring them up case by case, kind of next to each other, even just looking at the top 10 holdings and regions and sectors. If there is a lot of overlap there, there's probably a lot of overlap in the rest of the portfolio. And I think the last thing is timing the market, whether that is panicking at the bottom or hubris at the top when everybody thinks that they are the rock star manager. It's really important to manage that. So my final slide is, even if you ignore every single thing that I have just said and think that is complete garbage, that is fine. But I urge you to do one thing, which is to keep an investment diary. And this is regardless of what you invest in and why and how long you've been doing it. And this is because really, if you write down, if you articulate to yourself, even in one sentence or two sentences, when you make a decision, whether that is a buy, sell, a top up, a reduction, of why you did that, then it helps you figure out, is that a good enough reason, first of all? It also helps you, keeps you honest in the future around, why did I make that decision? Which really can serve you well in times where it's volatile. You might want to consider, do I need to make changes in my portfolio? If you can go back to what you were thinking at the time, what was the investment case? Why did you buy it? What did you think was going to happen? You can then not only learn from that, but help make better decisions in the future. So that's the last thing I was going to leave you with, and look forward to hearing people's questions. Thank you very much.
Perfect. Wow. I've got 3 pages of notes, so I clearly found it very, very interesting. And there's been a ton of questions from the community as well. So I'm going to rattle through some of them. So
Sure.
From Omar, how would you go about doing your due diligence on industries and companies that you'd like to invest in? As a retail investor who doesn't have the access to the same resources you have. And I guess the like follow on from that is, obviously you have experts that are picking these funds within TILLIT as well. What kind of things are they looking for? Like, I guess it's more of a process question. We're all busy. We've all, and we're modern investors. We've only got a certain amount of time in the day. Where do you start? What are the key things that you're looking for in each of these?
Yeah, I'll take the first one first. I think it's a really tough one because, like you said, it's access. And as I mentioned in the very beginning, I don't pick stocks anymore personally, because I think it is, if you want to make a decision based on fundamentals, I personally am of the view that you have to understand the company, you have to understand all of those things that I ranted off in the beginning, is that pouring through annual reports, going through the competitors' annual reports, going through any, and it's not even like press clippings, but if you can get access to, there is more transparency, more access being held to like earnings calls and so on. But if you can't speak to management, it is really hard. And I think this is why I'm not going to try and pretend that there is a golden way to do that. And that's why I think retail investors do more struggle with picking stocks, which is again why I think funds can be a better way. So on to that second one, I think this is where I would have loved to go into like what our process is a lot more. We have a 17-page TILLIT specific due diligence questionnaire that goes to every single asset manager, because we do some screens in the initial, like to try and figure out, is this worthwhile even considering? But then we ask for a lot of information from them. We ask them everything about team structure, culture. We talked about how they are. Actually, that's probably something I didn't mention earlier. The culture of the asset manager. Like if I give an example, we know on this call that investing is a long-term thing. But if you're considering a fund who's managed by an individual who works at an asset manager which is listed, for example, you have to ask yourself, that company has certain quarterly earnings pressures on. How does that translate into how their fund managers are assessed? No fund manager can outperform consistently throughout. Sometimes you underperform for years, and you have to consider, is that a structure where they are supported to do so if they have to? But it's everything from down to performance, down to investment case, down to how has that process evolved over the last few years? Who's feeding into decisions? How do you make decisions? How do you put size positions? All of those different things. And we have multiple meetings with the fund managers and pick specific stocks in their portfolios or assets in their portfolios to ask, what is the investment case for that? You have to, as a stock picker or as a fund manager, be able to back up why you own every single thing that you have in your portfolio. And so there's things like that. And then there's the active share around, you have to, which maybe I actually whizzed through a little bit quickly as well, is that if you're an active manager, you cannot outperform if you own the same stuff. And this is actually one key metric that I really want to emphasize, because it's quite hard to get hold of, and we're hoping there will be more transparency around here. But is an active share is really assessing, looking at the fund, what are those holdings compared to the benchmark that is supposed to outperform? And if it's 100%, then it's completely different, both in holdings and the portion sizes that it holds those things. If it's 0, then it's exactly the same. And as an active manager, you can't outperform if you're the same. So there's a whole range. I can talk about this stuff for days, but it is hard as an individual. And I think that's where platforms like ours and our others are trying to give you access to that information, even if you can't do those meetings yourself and do that due diligence, to give you access to the learnings that we're getting from it. Sorry, that's quite long. Sorry.
No, it's perfect. Very detailed. So the second question is, as a retailer, I guess that means retail investor, how can we invest in investment trusts and what platforms can we use? I'm kind of setting you up here. I know I'm aware it's hard to invest in this vehicle via eToro and free trade. So what are the ways that we can do this? And just a reminder, this investment trust is listed on an exchange, but it's operating as a company, can take on debt and things like that. So what are the platforms available?
Yeah, so I think, this community, we are probably more familiar with the eToros and the free trades of the world and so on. I think for investment trusts, so first of all, you can find out all of the investment trusts on the AIC website, the Association of Investment Companies. But in terms of accessing them, I hate to say one of our biggest competitors, obviously because I'm being transparent here, all of the bigger supermarket, kind of fund supermarket platforms, Hargreaves, Interactive Investors, Charles Stanley, AJ Bell, you will typically find all of them. What we do at TILLIT, we aren't a supermarket, we are a curated platform. We pick, as you mentioned, Eddie, what we believe are the best in class ones. So we have investment trusts on TILLIT as well. We don't have all, there's about about 300 investment trusts in the UK. We don't have all of them. I think you might struggle to find all of them on the other platforms, but typically if you go to the larger supermarket, kind of fund supermarkets, you will find a much broader range.
Yeah, perfect. And there's one question from Damandeep, and I know a lot of modern investors do use technical analysis. We've spoken a lot, or you've spoken a lot about fundamental analysis. So how useful is technical analysis in your experience of particularly determining entry and exit strategies? Do you use this? Is it important for the modern investor? Could you just shed some light on your experience with that?
Yeah, I'm afraid to say I'm probably not the right person to ask, because I am, like, in the sense of my experience has always been in very long-term investing styles, and there typically, at least we haven't used that. And I think what my view on technical analysis is that it probably can be a bit more helpful if you're a bit more short-term and you're looking to trade more than long-term, like make long-term investment decisions. I talked about trying to time the market earlier. If you find something that's great and you've done your research, you've done your homework, and you know why you want to own it, trying to figure out the most ideal entry point is essentially pointless, is my personal view. Even professional investors can't get that right. It's better to try and, like, if you find something you like, you're going to hold it for the long term, it will come out in the wash, is my personal view. So technical analysis, typically, my view of it, is more useful if you want to be very specific in the detail and is shorter term type of positions rather than longer term. So long-term investing, I would personally say it's not something that you need to focus on.
Yeah, thought so. So one question that's been upvoted extremely quickly right to the top, and it's just kind of come in. So when you left fund management, you mentioned that you stopped investing in individual companies. Obviously, you were managing Japanese equities and things like that. What were your struggles when for that initial transition period between stock picking and then picking funds, essentially, or trusts and ETFs and things like that? So what was the biggest challenge you faced, and then how did you overcome that in a way that's relatable to retail investors, so the audience can learn from that?
Yeah, it's an interesting one, because that is essentially part of why I left Baillie Gifford and to start TILLIT, is because I found it incredibly hard to do that well. The information that is out there, I touched on that, is really hard to know. There's over 5,000 funds in the UK. It's really hard to know which ones are worth even considering and what's the difference between them. And so based on what I had at the time to go on, and what unfortunately for the majority of the bigger platforms is still available, is I think the best buy list can be a good starting point. If for no other reason, then it does help. Some of these platforms do no due diligence or no research on these funds at all. They do due diligence, but they don't do any proper research that they share with the personal investor. Some of them do, but they typically tend to be on the best buy list ones. So that's a good place to start. And then it's one of those, you have to like cobble things together from multiple different ways. So I'd probably start with an area that I'm interested in. If I wanted, oh, I want a frontier markets thing, I would Google, start someone, try and find someone's on best buy list, then Google that name and find similar ones, and then find like broader kind of reviews and so on, and then go to what are those asset managers, go to those asset managers website, cobble that together, try to find, is there a listing for Morningstar, is there a listing on the fund manager ratings, all of those different platforms, to try and pull all of that together around what seems to be my options here. That takes a lot of time, right? And that is, and even then you might not have a good enough kind of understanding why you should do it. And that is, I mean, this is not a session trying to plug TILLIT, but that is what we're trying to fix. That is exactly what we're trying to fix, because it is really hard to do that. But I think that is a good starting point to try and do it. It's a similar approach to doing stocks. I guess the difference is, even if you have to put that time in the beginning, which we as keen investors on this call want to do and are happy to do, you end up with a decision that is related to a fund of a multiple of assets rather than just one stock. So I would say it's still a worthwhile thing to spend time on. But yeah, that's probably all I can say on that, unfortunately.
Perfect. And I've just seen we've unfortunately run out of time. It's been a very quick 45 minutes. There's lots of amazing comments and questions that we didn't get to, so sorry for that. But there's also one from Dr. Raj. I'm going to invest in TILLIT. How do I get in touch with you? So that's a great segue into how will the community and anyone listening to this on YouTube or whatever, how can they find you? What's TILLIT's website, etc.? A good opportunity to plug yourself.
Fantastic. Yeah. Yeah, we'd love to talk. We'd love for you to check out what we do. And you know, the Finimize community is exactly who we think that we have a great product that can help you solve and think about your investment solutions. So you'll find the website at the bottom here on the screen. So TILLIT Invest, TILLIT with TILLIT, invest.com. We're on LinkedIn, we're on social media, on Twitter, on Facebook, all of those things as well. And then on the website, you can then come in and you can see all of the funds that we have. There's a couple of things that to create an investment account so that you can also see videos of our fund managers are coming out literally in the next couple of days. And a few more unique, the kind of qualitative insights that we do, the TILLIT view, and all of those insights that we gather through our due diligence process is behind once you have an investment account. But you can check out everything else on the platform and find our filters and everything else if you go to tillitinvest.com or my.tillitinvest.com straight into the platform. But thank you so much for having me. This has been brilliant.
Perfect. Well, thank you very much, Felicia. And thank you, everyone. Don't forget to check out the next session on alts, alternative investments, in 3 minutes, probably 2 minutes now. I think the session will end, but thank you, Felicia, and thanks, everyone. See you soon.
Thank you very much.